Markets in Economies case study presentation based on Brompton Bicycle Company. My name is Luca Vallarelli. To regulate the bike market, there is a new anti-dumping tariff of 48.5% on bike importing from China. Let's recall the Brexit in January 2021, meaning that the UK left the European Union, and there has been a nominal exchange rate variation both for pounds versus euro and pound versus dollar. This means that pound has lost value, and theoretically this would make more convenient to buy in UK, positively contributing to British export. Now, what about if the tariff on Chinese bike is removed? What would be the impact to the UK's bicycle industry? And what might be mitigation actions that the UK government could put in place, and which are the pros and cons? So, Brompton Bicycle is a small company, 500 employees. Its core flag product is Brompton, which is a foldable bike, and it had a 20% growth since 2008, and it's operating on 47 markets globally. In 2020, the global bike market was worth roughly $30 billion based on Global Industry Analyst 2020. It has a projected CAGR growth of 2.4%. And what's interesting to highlight is that there are differences from country to country, and China, for example, is above the average with a 4.7%, whilst an European country like Germany is 1.1%. And yet, the COVID pandemic is actually having a positive influence on this market, resulting in a 1.7% of expected bike sales annual growth. So the impact of removing the tariff is represented by openness, which is the consumer's ability to choose between domestic and foreign products. So consumer will have a wider choice of products. Why that? Because the tariff indirectly represents a barrier to enter the market for Chinese companies. Since even if they have competitive prices, there would be a tax on imports, and often tariffs increase international prices, meaning that Chinese products wouldn't result convenient. This makes harder to those companies to enter the market. But removing the tariff will make it easier for those companies to enter the market, and consumers will have access to more products. Another consequence is that potentially consumers will tend to buy the cheaper products. And this would likely lead British bike producers like Brompton to lose potential sales opportunities if they do not implement any counter strategies. But if Brompton does decide to lower prices to compete against Chinese companies, surely consumers will be able to buy the Brompton bike at a lower price than before when tariff was in place. But actually, the overall market value could decrease if all companies decide to lower prices as a strategy to compete against the Chinese companies that are joining the market selling bikes at more competitive prices. Generally speaking, removing the tariff could represent the foundation for a more competitive market where buyers and sellers will be able to freely enter and exit the market. There would be similar products like bike that could be differentiated, like in style, type, for example, like standard, electric, foldable. And in that situation, British bike producers will feel less protected. Now, we've seen that we could look at the consequences of removing the tariff from different perspectives. Brompton company, representing whatever British bike producer company, Chinese companies entering the market, consumers, in this case in UK, and the overall bicycle market. This means that actions will have pros and cons, and what is an advantage for a given actor could result in a disadvantage for another actor. So, talking about the potential government actions, from the Brompton company perspective, an absolute quota that put a legal limit on the quantity on importable bikes would avoid a potential unlimited imports of foreign goods, even if there is no tariff-based limit anymore. Then a pricing floor would set a minimum price at which a bike could be legally sold, so that would avoid companies to set prices that are too low. Both absolute quota and pricing floor would cause deadweight loss, meaning a loss of economic surplus, which is the sum of consumer surplus and producer surplus. Considering the producer surplus is the difference between the market price and the minimum amount a business has to charge to make a profit, the pricing floor should be set at a value which would permit Brompton to still make profit. Actually, if it is set at the same price Brompton was already applying, the British company would be still protected from the Chinese entry. This precise edge case wouldn't give consumers the opportunity to find cheaper products because of new sellers joining the market, but still they would benefit from openness. Support technology R&D with incentives would help Brompton improve production efficiency, reducing costs, allowing the British company to reduce prices, maintaining profit. The government could also apply incentives on British products for under 40s, for example, since they are the majority of bike riders based on Technovia 2019, so that consumers are motivated to buy Brompton bikes even if new products would be available also from foreign sellers. The government could even launch a bike-sharing service, having, and therefore paying, Brompton as an exclusive service provider, compensating its potential revenues loss due to the new sellers joining the market, with new revenues coming from providing bikes for the bike-sharing. From the Chinese company's perspective, the as-is situation would already be good, always actually allowing them to enter the market and providing them room for expansion. For consumers, avoid putting quota and avoid putting pricing floor would represent a great chance to choose among more products, find them at a lower prices, and potentially have price decrease on products that were previously more expensive. For the market, the total absence of regulation, both on floor prices and quota, would potentially lead to a market value loss. So putting in place those two actions would defend the overall British market value. As shown at the beginning of the presentation, the bike market is going to have an overall growth, CAGR and sales globally. And we've seen that we could look at the consequences of removing the tariff and having further government intervention from different perspectives. So it's actually hard to find the perfect solution that maximizes the satisfaction of all actors. But in conclusion, after having seen some potential government intervention and having analyzed pros and cons before for the different actors, what we could say is that introducing the quota and a floor price would contribute to avoiding an excessive market value loss. Still, it will allow new sellers to join the market. It would permit openness, providing the consumers a wider choice of products also at cheaper prices. And the fact that there is a floor price would regulate and avoid presence of too low prices, limiting the impact on Brompton sales, because new bikes can be sold also at cheaper prices than before, which is good for consumers, but not too cheap to force Brompton drastically reducing its prices. So here you can find references to the material exploited for this case study. Thank you very much for your time and your attention.